Hello everyone, today is February 4th and this is our session number 5 of the Wyckoff trading course. Um, Today we're gonna cover the exercises, the homework that we had for the couple of last sessions. Specifically, we're gonna look into the distribution homework. We're gonna self-review the Microsoft homework. I'll talk about this a little bit more, but there are some spots that I want to discuss because they were common for everybody. By the way, I did receive your emails with your homeworks. So today I had time, and I also felt healthy enough to go through all of the homework. So I think I had a chance to reply to everyone, at least send a short note here and there. I must say that I feel comfortable with how the group views the price structural analysis right now. There are some small minor things that we will discuss, and the next homework, which will be Apple, also will be the homework on labeling. So this is another chance for you guys to practice structural labeling. Next session is going to be on February 11th. A quick comment from a student: this class has so much information and is a touch overwhelming, but I'll do my best to stay on the top of it. So yeah, this is a great comment. I love these comments, and thank you for those of you who are sending your emails and just thanking either me or the course. Thank you for all those kind words. Some of them I'll use as a testimonial. So if you guys want to send testimonials, I'll gladly receive those. We just save those, and then at some point we'll just put them on the website. We only disclose the first letters of students' names, so it's very anonymous. All right, let's see what we've got for today. So today's session is going to be, we're going to start with the review of the distribution homework. And because I want to go a little bit fast, this is already session number 5. So I will not call on anybody today, with an exception of a couple of spots. We'll see where those spots are going to be. But I just want to cover as much material as possible and go through as many homeworks as possible. We're still going to talk about some of the distributional patterns, specifically upthrust today. And then whatever we can do with the Microsoft homework, we also will do today. We'll try to review it. If we don't cover that, then this will become a self-review. So this means that I'm going to give you solution slides, and then you're going to have to check your labeling against mine, and then to see what kind of questions you might have. As I mentioned, homework for next week is, again, labeling. We're going to take Apple, and we're going to look into quite a lot of ranges in Apple's history. Next session, we're going to start on volume and price analysis. And our first task is going to be to dive into the volume and spread analysis. We'll discuss what we're looking in the spread, on the price side, on the volume side, and so on and so forth. There's going to be 2 homeworks. So homework number 6 is going to be on the volume spread analysis. And then we're going to start what I call a systematic exercise, where we're going to start introducing the concepts of volume and effort against the price or the result. And that exercise is going to last for about maybe 4 to 5 sessions, depending on how quickly we're going to go. Meanwhile, on the theoretical side, we're going to discuss a couple of laws that are going to be extremely important to us in the way how we approach this exercise. And specifically, there are the laws of supply and demand and the law of effort versus result. And again, if we don't have time, self-review of the homework on label, Apple. Otherwise, two homeworks that we're going to have next week. Now, don't jump to the conclusion that this is too much. These homeworks actually are going to be just one slide each, so you're just going to have 2 slides. So don't worry beforehand. All right, so that's the plan for the next 2 sessions. And let's jump to our homework review of homework number 3. That was on the distribution. And we went through the distribution. I gave you kind of like this theoretical material where, I've discussed the schematic, where I discussed the Wyckoff events, and I suggested that all of you would not only review those slides, but also to remember the characteristics of all of the Wyckoff events that happen in the specific phases. That's extremely important for us for timing and for bias definitions. Hopefully you've done so. So the first stock is Callaway Golf. This is a weekly chart. So we are looking at the uptrend. And when we look at the uptrend, we want to distinguish a couple of things. We want to understand what kind of characteristics all of the reactions are going to have on the way up. We also want to understand where the trend emerges and where the trend ends. In this case, we are given probably slightly limited amount of information, but we could maybe put the trend lines like this. And at the break of this channel, this is where we would consider that the trend is done. It's a break of a trend. And also, we could look at the character with which the price that's is moving up, and we could see that there are quite a few climactic runs into areas of the consolidations on the way up. Almost everywhere, you kind of could see that increase in volume signature, and then going into the overbought condition, short-term overbought condition. And the last run, not necessarily seeing an increase in the volume signature. So we see on the third leg to the upside, the character of the volume actually starts to diminish. That suggests that demand is being exhausted at this point. And then we're seeing the last bar on the volume increase, which suggests not just demand increase, but increase in the supply. This is the volume equation that we're going to be very familiar with once we start going into the next session, and when we will start discussing volume signature and how the price reacts to that. Well, then the next 2 bars have also quite a lot of volume signature. So we're seeing how supply has increased over the last period where we had a reaction. So with that, we're seeing some kind of change of behavior in the supply signature. So let's look at the price. What does the price do? Okay, we're seeing a reaction still within confines of the trend. So that's normal. It's still, even if we look at this reaction and we would compare it to the previous reactions, we're seeing that maybe the size of this reaction just ever slightly more, actually a little bit more, yeah, so distance increases, but not significantly. And it still happens within the boundaries of the support and the resistance of this trend channel. So until we see some kind of break of a trend, we might even assume that we're going to have a continuation. On the other hand, knowing the history of the stock, right, we know that there was a consolidation. And this was the last point at which the price has stopped going up. And all of the other points were just the retest of the same stop in action. So from the historical perspective, we know that this was the stop in action, and therefore this was a climactic action. The reaction prior to that was a preliminary supply, although not a lot of supply that has come at that area. So sometimes it's not going to be that significant to us. Preliminary supply will be an indication of where we might see some kind of stopping action in different phases on a very short-term basis. So this area could provide some kind of area of the support in the near future. As we recognize the buying climax, the next reaction is going to be an automatic reaction. We have discussed the volume signature, some supply increase, but it's not as significant as some supply that we see on the chart in the prior spots, in the prior reactions. So therefore, our conclusion here on the bias is still that we are most likely going to continue to the upside at this point of time. As the price goes up and reverses on this bar right here, we recognize that we are in the confirmed trading range. Buying climax and automatic reaction define the boundaries of the range with the support and the resistance definition. And then the next leg up, which is the test of the local test of the climactic stopping action, and then subsequent reversal defines that we can't go higher. And therefore, we are from now on in the non-trending environment or consolidating environment, and therefore we have entered phase A. Next couple of tests, and they are secondary tests as minus sign of weaknesses. So let's talk about this. Why are those secondary tests? What are we testing? Well, we are definitely testing the low of the automatic reaction in phase A. This is the main test. But the low of these tests are lower than the low of the automatic reaction. So therefore, lower lows suggest some kind of weakness, structural weakness. Whenever you see structural weakness, right away, look down, look at the volume signature, and see what supply is doing. We kind of could see that, yeah, there is some supply signature. There is definitely some increase, overall increase of the supply activity over phase A. So we're looking at supply in B, we're looking at supply in A. And it produces just minus sign of weaknesses. So we should be on the lookout. And here we would be thinking about the bias as still short-term bullish with weak elements. So that suggests that at any point, if supply comes in, or if the bullish picture, structural picture is going to deteriorate, we probably would be thinking that there is some kind of bearish, at least short-term bias, bearish bias that could be defined. So as we go up, we're seeing some kind of excitement on this rally up. These are two possibilities at this point of time. We could be looking at the possibility of a sign of strength or an upthrust. Sign of strength will be in phase D of an accumulation. An upthrust could be either in phase B or in phase C of a distribution. One of the things that we will pay attention on this rally is the characters with which the price goes up. We know that the sign of strength definition is going to be a rally that's going to travel from phase C throughout the whole trading range and above the resistance that was created in phases A and B. It's going to stay above there for some time, spend some time above, so not having the capacity to just tank on the bad demand or emergent supply, and then have some kind of reaction to new support. which before that acted as a resistance. Characteristics of sign of strength are going to be expanding spread, specifically up spread, and increasing demand. All right, well, we see how there is some kind of increase in the volume signature right here. And as this volume signature increases, the price moves up. So there is definitely some demand here. We just need to define what kind of demand it is. A good demand or a bad demand, weak hands demand, strong hands demand. We will see this only on the confirmation. By the spread, we could think that this could be a legitimate sign of strength. By the definition of the sign of strength, we need to commit and stay above. There is only one close above the resistance level that is a progressive close that makes the new high on the close. Please note that this bar right here, which is also a big up bar, but it doesn't close above the high of that last bar, so it doesn't produce that commitment that we need. So there is only one close here in this yellow small circle that shows us a temporary commitment to the upside, and then the price falls back under the resistance instantly on the next day. So this looks more like a definition of the upthrust rather than a sign of strength. So therefore, right here, we would be questioning, we would be making that judgment as to maybe this is not necessarily a reaccumulation, and maybe this is a distribution. Under the distributional scenario, if we are in phase C of the distribution, that upthrust is going to start falling and failing back into the trading range. It's going to create different points of last points of supply. It's going to create a major sign of weakness and last point of supply rally, and that's exactly what is happening. As it happens, the characteristics of the major sign of weakness are going to be of such where the spread to the downside is going to start increasing, and that's going to be on the increased supply signature. Why is this happening on the major sign of weakness? Well, that's because the trend to the downside is starting to emerge, and this is just another small capitulation within the trading range by institutions. They are recognizing that there is no absolute return over the last year or so. On the attempt to go out of the trading range, the price has failed, so they need to get out. There is no relative performance as well. If you would look at the history of the market in 1997, the market was going up. There is definite deterioration in their portfolio as to how they treat this position. They will be capitulating, and this is just an initial capitulation here at the end of 1997, beginning of 1998 by institutions, and those are smarter institutions. Those are the ones that are recognizing that the trend has changed, and obviously those are also trend following institutions, as they are the ones that are going to recognize the spot as that emerging downtrend. So on the rally, this is where you should get a lot of confirmation. We see that the price commits, not commits, but at least retests the new lows after the minor lows, sign of weaknesses in phase B. We're assuming at that point that we are probably in phase D, and we should be experiencing some kind of last point of supply type of rally. The first rally sometimes could be very aggressive, and we see it right here. It comes back into one half of the range. Well, it actually is a very logical thing because, as there is this short-term capitulation on the way down into the lows of the major sign of weakness, that creates two things. It creates a very short-term value proposition to weak hands. And again, by weak hands, I mean institutional hands and public, both, not just public. So we never want to position ourselves, talking about composite men against the public. This is an incorrect statement. We always want to talk about composite men as a strong holder, so therefore strong hands, and then other institutions that participate but on the wrong side of the trade, and majority of the public will be majority of the time, specifically, at the majority of the spots, it's going to be on the wrong side of the trade as well. So that's why public always has this kind of like negative view by the market experts. Okay, so this is a short-term value proposition, and then it also creates a short-term liquidity because some of the institutions are capitulating on this position with the profit. So that creates an opportunity. There is an absorption of short-term absorption of the supply, and that leads to this aggressive rally because a lot of the trend followers are trying to pick up the spot as the reversal and the resumption of the uptrend. And why wouldn't they? Look at the leadership prior to the consolidation. And then as we go through, there is not a lot of deterioration to the downside. I mean, we're not giving up. We're giving up probably what? Maybe like 1/5 of the last leg to the upside. So a lot of them are going to see value right here. And I think that the clue about this, ending of the uptrend was somewhere here on this gap, with a lot of the volume signature, probably earnings catalyst right here. And as we had probably earnings, very favorable earnings, then the reaction on earnings event is unfavorable for the first time, and that's after the absorption that has happened. So who's selling? Some other institutions are selling, and they are selling a lot. This is the highest volume signature since the beginning of this chart. So something is wrong, something is not going well. So at least at the minimum, the price is going to consolidate. And then we should assess as to how it's going to consolidate. Two rallies, very weak rallies, and as these two rallies develop, look at the demand signature, it diminishes, so demand becomes poor. And this is where we just basically say that the distributional scenario is unfolding, it's confirmed, and we could open the position and actually, short the stock. All right, so that's the whole story. Here is my labeling for you, and then a couple of questions here. In phase A, does automatic reaction have to be equal or lower than preliminary supply? Does the first secondary test have to be equal or lower than the buying climax? So we've talked about this a little bit, preliminary supply, and then look how we are connecting with this area later on in the trading range, multiple times. And by connecting, I mean that either we are testing with our short-term committing, testing, short-term committing below the area of the support. It's not necessary that it's going to happen this way. We might have multiple scenarios. We might have a preliminary supply that will be violated. Usually that would suggest that there is more supply that is coming in at this point of time, and it has this capacity to go through the support area of the preliminary supply. We could have the situation like we have on our current chart, where that area is being respected. And in some instances, the price just would stop exactly, around the lows of the preliminary supply. So all of the three possibilities are there, and we should make a judgment by how the price reacts towards that preliminary supply area. As for the secondary test, the same thing. We could have different tests. We could have very, very low test that suggest a lot of weakness. We could have a high test where we're going to say that this is a secondary test as an upthrust. And then we could have a test more of what we see on this chart, being on this in the same area approximately as the buy-in climax. And obviously, each test has its own implications. An upthrust test would suggest that maybe this is a leadership, and we might have, if this is a distribution, we might have a rising upslope in trading range. The weak performance of the secondary test might suggest either very poor demand and the price will have to consolidate before it's going to go up, or just a continuation in the hypodermic type of manner. And we'll look into this on other slides as well. Next question. In real time, would this area be labeled as a reaccumulation with the upthrust being a sign of strength in phase D on increasing spread and volume signature? So we've talked about this as well. There are some elements of a reaccumulation right here. Actually, not necessarily very favorable elements. I mean, if we would go into more details of this area, we would see that on average supply has increased, and that produced some minor weaknesses. So that suggests that there might be a possibility of a bearish scenario at some point. So therefore, it's not necessarily at that point that we would be thinking that a reaccumulation, but the first assumption will be that it is a reaccumulation. All right, next question. Can we only confirm distribution on a break of the support with volume? So I think that I've shown you guys kind of like a gradual change of bias or perception by us as to how we analyze this whole trading range. We could see that here it's going to be extremely difficult for us not to give the beginning trading range a definition of a reaccumulation. Then only in phase B, we're going to have some kind of doubt that this is just a reaccumulation, because even though it looks like a long-term picture is still a reaccumulation, we see on a short-term basis some kind of a deterioration in the increased supply signature and result to the downside that is slightly increasing. So that suggests short-term bearish picture. And then as we go into phase C, into the upthrust, and we see the failure, this is where we're saying the upthrust failure suggests at least a short-term bearish scenario. And then once we go into major sign of weakness and then the LPSY fails, this confirms a bearish bias. So this is extremely important what I've done right now for you. It's another way of showing to you of how perception is going to change through the analysis, through all of the phases. And we might be coming into this trading range thinking that this is a big leadership stock and we would be looking to buy this stock. And the timing of phases would not allow us to necessarily buy right away in phase B. We would be waiting maybe for the backing up action if we thought that we missed a sign of strength here. And yet after that, the perception is going to change and we're going to change our bias. So, and that's why, it's a non-linear analysis that we are conducting here because everything changes. So it's a kind of like ongoing. But at the same time, I understand that some of you, especially those engineer types, you guys are going to be thinking about a lot of data points here and how could you convert that into the bias decision. And I think that that's possible. It's just that you need to define, the interaction between those data points and the deductions that you make. All right. Question, and then we're going to go away from this slide. large volume spike in May cannot be concluded as effort versus result based on volume and price signature. So this one right here, yes, from Roman. So this is more of what we would call a late institutional capitulation, right? So we had like an early institutional capitulation on this volume signature. This is a late institutional capitulation. Sometimes it comes on earnings as well, and it kind of moves the stock and the whole chart into a different environment, from a non-trending environment to the trending, which is the downtrending environment. And at this point, the institutions that are giving up their position, they are not necessarily unprofitable. They could have been holding on to this position for quite some time. So their profits are built in. They could be scaling out at that point. But a lot of the trend followers are going to capitulate here. And that's because the trend has been decisively broken. And not only that, the consolidation that they may have thought was an reaccumulation is actually resolving itself as a distribution. So this is where they're going to give up. They're also going to give up here. So these institutions are probably already going to have some kind of either unfavorable profit picture, or it's going to be even unprofitable proposition if they were buying on the way up. All right, so a couple of questions from Nilesh. Why was logarithmic chart used for this analysis? Was not relevant at all, for any type of the chart to use. The purpose of this exercise is to label, so that's what we're doing. Next question. About phase C, what is the difference to label it as an upthrust after distribution instead of the upthrust? Okay, so we're talking about this spot right here. So the whole idea about the upthrust after distribution, and I think that I've discussed this in the last session, Eric. So why is it after distribution? Because the assumption was that distribution has already happened by this point. And again, this is very erroneous statement that was taught to us before. It doesn't mean that by the upthrust in phase C, all of the times that distribution would conclude. And this is a really great example of this, because we don't see a lot of elements of the distribution until we actually come to the later phase D. So therefore, it doesn't necessarily make a lot of sense to me that we call this the upthrust after distribution in this case. So therefore, I kind of consider this a legacy name, or legacy semantic. And even though we're using it, we need to understand, the proper usage of it, the functionality of it. All right, let's go to the next one. Okay, let's talk about the upthrust. Okay, so upthrust and upthrust action. Those are two different things that we want to distinguish. And the first thing that we're going to talk about is just upthrust itself. And the definition of the upthrust is a temporary commitment above a level of resistance and almost immediate comeback into the trading range. So, and we see how upthrust happens this way. So there is some kind of excitement. The price commits temporarily, or at least tries to commit temporarily above the resistance level, and then it fails almost instantly. So in the first case, right here, we see a close above. And again, the way how I'll look at upthrusts and sign of strength is I'm looking at the progressive closes to the upside. So what do I mean by that? I want to see how many closes are actually above the resistance, and how many of those closes are going to follow up and continue to the upside. So for instance, let's look at to this trading range, and we see that there is close number 1 that is above the resistance area, and then close number 2 that is higher than the previous close. So we have 2 consecutive progressive closes to the upside. And then close number 3 that also has the same characteristic. The price closes above the previous close, or above the area of the resistance that defines this area. We don't see that necessarily with upthrusts, right? So we see one close and then one bar that tries to close above but fails, and tail creates the supply tail. So we only have one close at this level. The same here. This was even just an attempt to upthrust rather than the upthrust itself. Why is this an attempt? Well, because the price opened with the gap up. It was a gap above the resistance, and then for the whole session, the price was trending down and it closed below the support area. So therefore, it was an attempt to upthrust. It was an attempt to temporarily commit above, but it was not necessarily the upthrust itself. And then in this example right here, on the chart below, we see a close above, and then again, there are no commitments above the last resistance that was created. So just one close above the resistance, and that's that temporary commitment of the upthrust. The upthrusts usually were discussed in 2 places. Actually 3 places, but in the distribution were discussed by Wyckoff in 2 places. Upthrust in phase B, and obviously phase analysis came later. So Wyckoff was talking about the upthrust itself, and then upthrust after distribution. And we've discussed this upthrust after distribution. The only thing that I want to add to that for the upthrust after distribution, just because it is in phase C, we're going to have the equivalent of the second point of fear that we've discussed for an accumulation. So a second point of fear usually is going to occur into the lows of phase C, just because supply has increased as the price approaches the support level, and that triggers the worries of the weak hands, and they start providing liquidity to the market by selling their positions. That could take the price lower. So with the increase of the supply signature, volume is going to increase as well. And the result to the downside on the short-term basis is going to increase too. And that's what we call a second point of fear. It's going to be associated with the first point of fear, which is the climactic run into the stop in action in phase A. Now think about this in the reverse. Think about this as a distribution right now. If we have had points of fear, then on the upside, we most likely are going to have points of excitement. First point of excitement is going to be a climactic run into the stop in action of the buying climax. It's going to be associated with some volume increase and some spread increase, momentum, velocity increase to the upside. This second point of excitement is going to come into the highs of phase C. And usually that second point of excitement is going to be more evident on the upthrust rather than on the last point of supply rally. And we kind of see it from here, right? The rally before in phase B looks somewhat more interesting. But there are some elements of excitement on this last rally. As you could see, the volume signature increases, the spread to the upside increases as well. The true range of the gap action also happens on the increased spread and increased volume signature. Those are the elements of weak hands excitement. They are getting into this position because they are recognizing in their minds that their trend is emerging. Unfortunately, it's going to fail and it's going to act as an upthrust, and the price is going to come back into the trading range. But this is the area and the rally that we want to recognize as a second point of excitement. What does it give us? Well, it gives us the timing. The timing of what? The timing of phase C. And obviously phase C is one of the most crucial phases, because in phase C, at the highs of phase C, this is where the downtrend is going to start. And this is where we're going to start having the environment where the volatility is going to increase. And we're going to start seeing on that volatility diminishing result on the upside and increasing result on the downside. And we want to catch that emergence of the trend. All right, let's look at the next example. And this is an interesting one because usually there are some of the difficulties associated with this chart. So really quickly, a volunteer, say yes, and I have a couple of questions for you here. A volunteer, okay, let's go to Rama. Hey Rama. So this is going to be very quick. My question is, where do you see a consolidation here? Where is our trading range? How do we find it?
I found when I was doing this homework, the trading range starts sometime after February 7th,
Okay.
where, yeah. And then.
So what is this point then? If this is the beginning of the trading range, then how would we label this?
I would label that as a buying climax because
Okay.
the price signature.
Okay, great. Okay, Rama, thank you. So I just wanted just that question. Okay, so yeah, this is a good definition of the of where the trading range would start. Now the question here is, how do we confirm that this is the beginning of the trading range? Well, again, this is a historical chart, so there are quite a few points of references for you. But imagine that we are just maybe somewhere here. We are still in the definition of the uptrend. Look at the higher highs, higher lows throughout. So there is no way that you will be thinking that this is a distribution and that we are in the trading range or anything of this sort. Now, the key here was identifying this buying climax was the characteristics of the climactic run and characteristics of the change of character. The characteristics of the climactic run included acceleration to the upside, gaps, increased spread to the upside, and then stopping action, after which the price produces the largest reaction to the downside that we have seen or that we see on this chart. That suggests at some point that we're going to have some kind of trading range. Now, we see from the next action into a possible secondary test after the automatic reaction that the price does not want to go lower. So what does it mean? It means that there is still some strength around this spot. So, and what does it mean? That means that most likely we're going to continue with the upward movement. And if this is a trading range, that we might possibly have a downsloping trading range. Now, at this point of time, if you're going to tell me right here that we are going through the distribution, most likely I'm going to say no. And I'm going to say that short-term picture at least is going to be to the upside. And there is no definition to the downside yet. At least everything what kind of came is very short-term oriented. Even if we talk about this reaction right here that had some kind of increase of the supply signature, but it still created a higher low. The price quickly rebounded to the same ground and did not want to go down afterwards. Those are bullish characteristics, not bearish. So therefore, our a bias still will be bullish, and it will be bullish until we actually see this reaction right here. This becomes the largest reaction that we see on the chart, and it also breaks a couple of intermediate support levels. So it's either a potential phase C or it's a major sign of weakness in phase D. So now that we're seeing the structure a little bit and we're saying, okay, buying climax, automatic reaction, secondary test, and we have some kind of upsloping structure, then we could connect this structure like this. And then think about what happens at the edges of this trading range. What we are seeing is the price commitment into the overbought condition, where the price again commits only once or maybe twice and then comes back into the trading range. This is more of a definition of an upthrust than a sign of strength. And then for the first time, a break of two support areas, and this is the largest reaction in this trading range. So looks a lot like a sign of weakness that tries to commit below the support. We would be seeking the confirmation on the last point of supply rally, and it does come. All of the rallies are extremely weak. And actually, this signature is almost identical to the colorway golf chart that we have seen on the previous slide. Aggressive rally to the upside, gap to the downside, probably pre-earnings gap, and then earnings gap somewhere here, and then the rallies that are very, very weak rallies. This was an actual trade. I traded the stock at that time. I shorted the stock right here in this area. And then instantly you're rewarded to the downside, and we see how institutions are entering this capitulation zone, and they just don't care. They want to sell, 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 and that's why the price travels down so fast, so quick on such big volume signature. So it was a challenging chart because, again, we are looking at how the leadership stock like Netflix is being distributed on the way up. And we're seeing that initial elements of distribution happened here, 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 and then just a capitulation, overall capitulation here. It was such a darling, nobody wanted to get rid of it. So therefore, when people don't want to get rid of it and the conditions change and they want to get rid of it really fast, this is how quickly the price is going to go to the downside. And that's why the trades to the downside require less time than the trades to the upside. But obviously, trades to the downside always have a limitation, as you cannot go below zero. All right, let's look here at some of the questions. Upsloping trend can be mistaken for a reaccumulation in real time. Is the low volume on the move higher a clue of demand of poor quality? I'm trying to detect where a subtle distribution is coming in. Yeah, you could definitely think of it this way. It's not necessary at this point of time of the uptrend, especially think about this uptrend in Netflix that has started at the lows of 2009. So this trend has been lasting for more than 2 years now. So it's not necessary to have an extreme volume signature on the demand side and for the price to go up. We kind of see it here. Volume is low or demand is low, and yet the price is making a progress to the upside. And at the same time, if you remember the history of the market, we had a trading range in the market. And this trading range was more horizontal, whereas here in Netflix, we see more of the upsloping trading range. So we definitely outperforming the market at this point. So there is no reason for institutions to give up this position. They're still receiving an absolute return. They're receiving a relative return, and they are really happy with this position until this quarter comes. And this is where they capitulate. So this analysis is kind of like a rollover analysis on the bias, especially with the stocks that are going to be extremely winning stocks, the leadership stocks. So you have to be extremely akin to this area right here where the change of character takes place. All right, let's talk about the next time when on the next possible way of how we could address upthrusts. One of the ways that Wyckoff talked about upthrust is a measure of momentum. He used the upward thrust in the uptrend as a distance between the significant highs that are being reached and where the price stops for a significant period of time. And he looked at the progression of those highs, and he would determine whether momentum was increasing or decreasing. And in this case, we see how the upthrust or upward thrust is diminishing, so momentum is going down. So that was another way of looking at the upthrust as a measurement of the momentum. By the way, look into this distribution, how this happens, right? So what do we see here? Where the institutions are selling the stocks first. So probably somewhere here, right? So this looks like that climactic run. Somebody might argue with me that this could be a climactic run, and you could be absolutely correct about that, and we could label it in two different ways. The climactic characteristics are present in both cases. So I would probably go first like this, with the horizontal range, define phase A here, and then phase C somewhere here. So B is almost the same size as A, so not necessarily the preferable scenario, but still possible. Major sign of weakness, and then LPSY area, and LPSY has its own range. So look into this smaller range right here, and look at this upthrust action. And look at this upthrust. What does it look like? It looks like somebody is coming in and demand is increasing, but result to the upside is decreasing, right? So this means that there is a lot of effort to the upside, and yet result to the downside is diminishing. So that's a bearish sign. And this becomes this upthrust becomes a second point of excitement for weak hands. They're trying to play the reversal here. Okay, well, we've talked about the upthrust, we talked about the upward thrust in the uptrend. Let's now talk about the upthrust action. What is the upthrust action? So one of the things that we recognize is that the upthrust could happen in the accumulation or reaccumulation as well. How is it possible? Because we were usually taught that the upthrust is going to be defined only in the areas of the distribution. Well, the swings above the resistance level in the reaccumulation or accumulation could act in the same way as an upthrust itself. Those swings could temporarily commit above the area of the resistance, and then the price can come back really quickly back into the trading range. And that's what we're seeing here in both of these scenarios. Our first upthrust action is actually a secondary test to the buying climax that we experienced in prior to that. Look into the a change of character that defines that the uptrend is done. This is the largest reaction here. And then going into the secondary test, just because we upthrust, we could say that this is a secondary test as an upthrust action. So it acts like an upthrust, but because this is a reaccumulation, we can't say that this is an upthrust. It's an upthrust-like action in the accumulation reaccumulation. And the same happens in phase B here for the small trend rate, for the small consolidation. We're committing to the upside actually quite significantly. That shows an element of strength, so we could call this actually a minus sign of strength here, but it acts as an upthrust, commits temporarily, comes back into the trading range. So that type of action in accumulation or reaccumulation we would call an upthrust action. All right, questions. But in real-time analysis, we can't know it's an upthrust or upthrust action, or can we? Okay, again, we're coming back to this kind of like our rolling over analysis, right? So my point, again, and I see how some of you are kind of like, thinking about the real time, and you guys are getting stuck there with that type of thinking. Don't think of this analysis as something that you need to define in the moment right away. That analysis could develop and become a more complete picture as you get in more data points. So therefore, when we are thinking about this upthrust right here, we might be saying, okay, yeah, we definitely know this is a secondary test. Buying climax, automatic reaction, secondary test, we know that. And then somewhere we're going to know that there is an upthrust action here. So that suggests some strength, and that suggests some reaccumulation, but we yet have to confirm it. That's our first assumption. So you see what I'm doing here? I'm not necessarily saying that this is an upthrust or it's an upthrust action. I'm just seeing this action as an upthrust, and that gives me some kind of suggestion on the buys that I still need to confirm. So therefore, going through this whole range, again, somewhere here, we might be thinking that there is some elements of strength and so on and so forth. Here we might be thinking, okay, is this an upthrust or a major sign of strength? So we would be actually thinking that this is an upthrust as the price goes down here, but it's going to be a major sign of strength to this area right here. So analysis unfolds. Analysis is not linear, and definitely I want you to recognize this. If there is one point from today's class, that would be it. That's a very, very important point. So let's kind of get it. Okay, next chart, and this one I'm going to discuss right away with the labeling. So this is Apple, and actually, why did I do this? Okay. All right. Well, we'll see how you're going to handle this with the next homework. So a leadership up run into the stop in climactic action. A change of character is well defined in the with the increased volume signature, where we say that supply has come in. This is early institutional distribution into the weak hands. Weak hands are seeing some kind of value, short-term value at this point, and they are buyers. And rightfully so, because on a short-term basis, you are going to have some kind of rebound out of the what now seems to be an extreme oversold condition right away. A minor sign of weakness, that's the first suggestion that there might be some kind of short-term bearish bias if both price and volume fails. But instead, we're having elements of a reaccumulation, suggesting a short-term run. So we're still thinking that, the continuation to the upside. And then just again, minus signs where we see some kind of selling, but still it's not the pronounced reactions that we see with that type of selling. So therefore, our first concern about the bias here is only after the upthrust has been reached and then it fails. So somewhere here, this is where our perception is going to start changing. Again, look at what I'm doing. I'm not suggesting a distribution here. Look at this volume signature, diminishing volume signature, diminishing supply signature on the higher highs, higher lows. So what are you going to do here? If you're a long-term investor, you're still in this position, you're holding on to this position until this failure. If you're a swing trader, you're initiating a position to the upside and your exit is going to be on this bar right here, on this change of character bar. And in both cases, it's still worthwhile to either be in this position or to hold on to this position. And then some of us are going to be thinking that this is too much supply, so maybe in the future, if there is some kind of failure, the bias is going to change to a downtrend rather than an uptrend or a consolidation. And that's exactly what happens. On the major sign of weakness, we see the reaction that is the largest reaction in this trading range, and that defines institutional selling on the way down and suggests that we are in the distribution. So after that, it's only tactics. We want to open the position after the last point of supply, the first rally again out of the short-term oversold value proposition for some of the institutions, and that's why the rally is so quick. Then look at this whole trading range and look into this rally right here. What can you say about this rally? What are the characteristics of this rally? Some small increase of the demand, more local than global, and the result to the upside is diminishing. Those are going to be, and it looks like a second point of excitement. And then a failure right away, and then a failure again on the gap, and then a failure again on the rally. Those are all bearish characteristics, and therefore we would label this as a redistribution to the main distribution range. All right, questions. The swing buy is because of diminishing volume with uptrend. I would be afraid of the gap down. Yeah, exactly. So diminishing volume signature, higher highs, higher lows. You could label this trading range. Here's the range that you're looking at. So your phase A is probably somewhere here, phase B low, and then you could probably squeeze in phase C right here, or you could have a phase C here. Now, Philip is talking about this gap. All right, well, if we would look at this gap, look at how effort has increased tremendously, yet what was the intention behind this reaction? It's to commit below the support level. Have we done so? No, we haven't. So therefore, diminishing result to the downside on extreme volume signatures suggests a presence of demand. So presence of demand or increasing demand suggests absorption. And we only need a confirmation of price that after such absorption, the price could go up. And we see that exact thing on the next 3 bars or so. And as it happens, we definitely want to get into this position. If we miss this point of entry, and by that I mean 1 and 2, then we could definitely come in on after the backing up action, especially on the breakout. So here is our point of entry number 3. Those are the only points of interest that we see here. And then our exit is going to be here, here, and then on the failures, on all of the failures to the downside. So just basically down, down, down. This is not necessarily is going to be a winning trade, but it's going to be like break even, small win, small loss type of trade. This is the trade that usually is going to be either in the correct direction in phase B, or it's going to be on the failure of the continuation of the previous trend. In this case, a failure to continue with the uptrend after the upthrust, and on the what seemed to be the emergence of the continuation of the uptrend and then the failure of that. All right, let's see what else. Why automatic rally or automatic reaction is there instead of the position that actually is occupying the minus sign of weakness? Okay, so we're talking about this spot, automatic reaction instead of this. So the suggestion from Eric is to go all the way. Well, we usually would be thinking about swings in the trading range, right? Look at this. So each swing is going to be defined by a reversal at the beginning of the swing, and each swing as an end of the swing is going to be defined by the opposite reversal. Those are going to be points of confirmation. And those are going to be the last points where we will know that the swing has reversed. So therefore, we would define our labeling based on the swing analysis. Right? So here we could see that a swing goes down. There is no reversal in this bar. No reversal in this bar. Then it goes down again, and then there is a big bar to the upside. This is the true range of that bar. It closes right here. It closes above the closes of 1, 2, 3, 4, 5 bars to the downside. So we see that this was a swing to the upside. Swing to the downside, swing to the upside. Automatic reaction, secondary test. Swing to the downside. Minus sign of weakness in phase B. All right, next question. Okay, more like a comment. Okay, from Rama. 2 most important and vital thinking skills essential for mastering this course: flexible thinking and nonlinear thinking. Yeah, I would agree with this, but I would say it's just not necessarily just for Wyckoff. I think that we kind of used to in life to create systems for ourselves, right? So there is a system of how we drink tea in the morning. There is a system of how we take care of our children, and it's all systematic in our head. We just don't even sometimes think that this is a system, but you have rules, you have steps, and everything happens in some kind of sequence, and then you just have deviation from that. Well, with the markets, unfortunately, we have to be systematic, but we are functioning in the environment where there are so many variables, so many data points, and it's uncertain in the way of how these data points are going to be presented to us on each particular day. So therefore, we can't really have simplistic steps when we judge the market. We have to have a much deeper understanding, and therefore we have to have more data points. With more data points, with the analysis of that, we just naturally get lost. And there is a tendency to go in just to say, okay, well, I want the rules. So give me the rules, and then, I'm going to just go by the rules. And usually I see that with students, they just kind of like take the rules and then strictly want to follow those rules. But there are quite a few exceptions. And you have to either remember all of those exceptions and have the very much clearly defined rules, or you have to be a little bit more flexible and allow the analysis to unfold, allow the picture to kind of like this puzzle to be all of the spots to be connected to each other. So it's a rollover analysis, so to say. All right, let's go to the next one. All right, we're doing great on time. I like that. Okay, so composite. And again, I'm just going to go right away into the labeling here. So three trading ranges. The first one is very small at the top. So we're looking at just probably even intraday picture right here that we need to figure out. And this is a very quick trading range. Well, another reason why this happens so quick is because it's a TP formation. So we have speculation on the way up, and this has been happening at the beginning of 2000, and then urgent distribution on the way down. We see that from the volume signature increase and how the price reacted to the downside. After this reaction, there is no way we don't see the bias. Why? Well, because it did not develop like this, where there is no progression to the downside by the price. It did not develop as a horizontal trading range. It developed as an urgent sell-in by institutions on two legs to the downside, actually three legs to the downside. And at this point of time, you already should be thinking that this is a significant deterioration to the secular trend, and therefore, most likely, long-term bias is going to be down. Now, short-term bias, because of this reaction right here that has elements of diminishing down spread, diminishing supply signature, that suggests that the short-term bias is going to be to the upside. And that's another difficulty in students' analysis that I see. Thinking about two biases at the same time for different time frames. Thinking that the long-term bias here is to the downside, but that the short-term picture most likely is going to be technical picture, is going to be some kind of rally. And most likely out of this oversold condition, which is extreme at this point. Think about for the whole time that the trend was up, especially in 1999, when the price was going up, up, up without stopping, kind of like a 2017 type of market that we have had just recently. Going down so fast, so quick is going to define an oversold condition for us, and that's going to be extreme oversold condition just because we've never seen this before in the last year or so. So that suggested a rally. A rally suggested that we might have some kind of upthrust situation. So we're looking for the upthrust, we're looking for the test. That usually would define phase C for us. And then we're also looking at the upsloping structure of this whole formation. And we're seeing, we could connect the highs and then from the lows of the sell-in climax, extract the next parallel line, and then from the lows of the secondary test as a sign of weakness in phase B, extract the next line. And look how perfectly the major sign of weakness, I don't know why I don't have this label in here, major sign of weakness is being defined by the commitment below on multiple closes down, 4 closes down, rather than just an attempt to go down. And then a last point of supply, a rally, has some aggression to the upside, but finds the resistance at the level of support. And then the second rally shows that demand is starting to deteriorate and that the result to the upside is also deteriorating, suggesting that this is the time right now for the price to go down. As the price goes down, another trading range. This one is a peculiar trading range because it unfolds so quick. So you have to think, because we're looking at the historical chart, as to where is my last point of supply, where the trend, a downtrend, is going to start. And we know that the trend has started at this point. So most likely this is going to be phase C. And then a selling climax, automatic rally, secondary test, and then everything in between is phase B. Okay, questions here. Can a distribution occur without phase B? This is a really good question. Some distributions with fewer bars, to my eyes, appear to not have phase B, but proceed from A to C. And we obviously are talking about this trading range right here. So the way how we would be looking at this trading range is there could be multiple ways. We definitely recognize that this is a major sign of weakness. This is a change of character. We also recognize that this level of support is probably crucial because the rally comes exactly to this level. So we're most likely talking about just this picture right here. Again, I have mentioned a TP formation. In a TP formation, we're going to have two types of charts. We're going to have what we're going to call a hypodermic TP formation, where there is a speculation on the way up and speculation on the way down, something like this. And then we're going to talk about the TP formation, where there is an urgent selling in phase A, and then we are residing in the lower part of the trading range, and we never touch the buying climax high, and then the price fails. So in both of these cases, the distribution at the top is going to be very fast. So therefore, your phases are going to be all collapsed. And the rule here where we say that phase B is going to be the longest phase is not going to be applicable, just because there is an urgency to sell by institutions. So, and that's the key to the collapse of the phases in either a hypodermic scenario or on the accumulation. We're gonna see, that collapse like in the shakeout type of situation that we've recently have had. Okay, next one. Can a secondary test in phase B be lower than the selling climax level? Secondary test in phase A, so somewhere here, below than the selling climax. Yeah, of course, we could have this. Look at this, right? So this is why this question is here, yeah. So look at these two scenarios. In first scenario, we see that the secondary test is a high low. In the second scenario, we see it as a low low. And in both cases, there are suggestions. What are the suggestions? A high low suggests some kind of strength. And think about this. I'm saying strength. I don't want you to think linearly about this statement, because we defined that the long-term bias after this move to the downside was down, and then a short-term bias was defined by us out of the oversold condition here as up. So therefore, a high low and the strength that secondary test shows at this point of time suggests that and confirms the short-term bias to the upside. It doesn't confirm a long-term bias to the downside. It just suggests that short-term we might have some kind of reaction. In this case, a lower low on the secondary test suggests what? Suggests more presence of the supply and suggests that demand is poor. So therefore, we would be thinking that the next rally that we still have to have into phase B and phase C could be of weaker quality. And therefore, we're definitely interested in the trade to the downside. shouldn't redistribution start with the buying climax? No, why would it? Right? So how does redistribution happens? Okay, so maybe we didn't go through this material, but we did go through the reaccumulation. So I'm kind of, in my mind, thinking that you guys are converting that into the redistribution. Okay, so reaccumulation is going to start with what? With the stopping action. It's going to be an intermediate buying climax. And then after that, we're going to have an automatic reaction, secondary test, and so on and so forth. But it's going to start with the buying climax. Why? Because the price was going